REITs, or real estate investment trusts, are a game changer for your portfolio. If you're looking to live off passive income or retire early and replace your full-time job with some solid cash flow in the form of dividends each month, dividend stocks are great, but a REIT is likely shooting out a dividend 3 to 5 times bigger than normal dividend stocks or ETFs you may be holding. This video is going to go over 5 of the best REITs for 2024 and explain why this asset class is one of the best to be buying in 2024, even over the likes of Nvidia, Tesla, and some of the crazy growth ETFs that have been crushing it this year. I'm Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. REITs, or real estate investment trusts, are actually some of the easiest ways for you to get involved and invested in real estate. If you've heard that it's smart to diversify your portfolio and invest somewhere other than purely equities or company stock, and want to find a more attractive return and cash flow than bonds, REITs is definitely where you want to be looking. A real estate investment trust is a company that owns, operates, or finances income-producing real estate. REITs allow anyone to invest in portfolios of real estate assets the same way they invest in other industries, through the purchase of individual company stock or through a mutual fund or ETF. I've been an investor in actual physical real estate for many years, and I can tell you that it's a very good way for you to build wealth, but it's also a big way for you to have lots of headaches. Owning a REIT lets you be a much more hands-off investor while still being able to invest in that great asset class. The first REIT on this list is one that I've actually talked about on this channel before, and it's one that's very, very big right now because a lot of dividend investors are going crazy over this one. And this is called VICI Properties Inc., or ticker symbol VICI. This company owns one of the largest portfolios of market-leading gaming, hospitality, and entertainment destinations, including Caesars Palace Las Vegas, MGM Grand, and the Venetian Resort Las Vegas on the Strip. The portfolio is comprised of approximately 127 million square feet and features approximately 60,300 hotel rooms and over 500 restaurants, bars, nightclubs, and sports books. VICI has strong moats with a resilient business model, high barriers to entry, and stable rent collection, leading to consistent growth and high margins. One thing that I thought might be scary investing in this sector, one that has casinos and gaming and hotel rooms, is that when something like COVID happens and shuts down the place, and people can't actually go and use these, that might bring down the total revenue. But that was the opposite with VICI. Through the whole COVID pandemic, they received 100% of their rents and actually continually grew. When we look at the evolution of Las Vegas tourists from 2000 to 2023 on Statista, this number showed an upward trend and a rapid recovery in the post-COVID-19 period. Although the number decreased last year compared to 2019, the upward trend seems to be continuing, with industry experts saying that Las Vegas has eliminated seasonality and seems busy all year round. VICI has a market cap of $30.2 billion. It has a low PE ratio at only 11.5, which is very attractive. The current dividend yield is nice and high at 5.72%. The current price is $29.04. Year to date, it's down about 11% for a nice little sale, and over the last 5 years, it's up 30%. I just love the resilient business model, that high dividend yield, and the fact that they're in a very high barrier to entry category. Now, before we move on, I definitely need to go over something that's very important for dividend investors, and that's taxes. The way that REITs are taxed is different than that of other dividend stocks, because the taxes on these dividends will be a bit higher, since the majority of REIT dividends are taxed as ordinary income up to the maximum rate of 37%. Qualified dividend-paying stocks like Johnson & Johnson or Coca-Cola are taxed at the qualified tax rate, which is more like 15% for most investors. Okay, the next REIT on the list is one that I've talked about on this channel before as well, but it would just be crazy for me to leave this one off the list, or anyone leave this one off the list when you're talking about the best REITs possible. This one pays a monthly dividend, so not quarterly. You get to have a dividend every single month, and has declared 648 consecutive monthly dividends and are a member of the S&P 500 Dividend Aristocrats Index, having increased the dividend for the last 29 consecutive years. O, or Realty Income, is a REIT that owns 15,450 commercial properties covering 89 different industries. The diversification speaks to the safety of realty income, at least relative to most REITs, with more concentrated portfolios. Even Realty Income's portfolio is quite safe, since its two largest industry concentrations are supermarkets and convenience stores, a pair of segments that have been historically resilient in good times and bad. O has a market cap of $47.89 billion. The PE ratio is 51.16, which is high, but only because the stock is down so much due to the market rates. The current dividend yield is 5.74%, and the current price is $55. Year to date, it's down 6.10%, and over the last 5 years, it's actually down 19.7%. But remember that they've consistently held a dividend above 5% each year. Realty Income is already a solid type company, but they're going to do even better when those rates do start to fall, which will make it easier for them to finance further expansion and only make us as investors much more rich. Now, while this video is about investing in real estate digitally in the form of a stock, another aspect of real estate to consider is buying land for cheap. So thank you to the sponsor of this video, Land of Land, which is America's premier land wholesaler. Looking to diversify your portfolio? Consider vacant land. Including land assets can help spread risk across different asset classes and hedge against market volatility because, as you know, land is a limited resource. I like this as an option for investing, but I also like this as an option for someone to be able to buy land and then be able to build the house of their dreams for later on. Land of Land streamlines the buying process, keeping costs low and transactions quick. You can even handle everything remotely, often in just a day. Go to this link to register for their next auction at landoflandauction.auctiontex.com. The link is found down in my description, and be sure to enter code PROFG, P-R-O-F-G, to receive a $300 reduction on your total invoice on land you win and purchase through its auction. As Mark Twain famously said, buy land, they're not making more. Now, the third REIT on this list is one that's in a specific industry. And this one makes a lot of sense to be invested in since it's in something vital literally to our health and wellness and will never be something that people don't need. This one's in the medical industry and it's called LTC Properties. And this solid REIT has almost a 7% dividend yield. This REIT holds a lot of senior housing and is a great play on the fact that America's aging population needs this more than ever, with demand remaining high and only projected to grow. This one's one of the smaller REITs here with a market cap of $1.53 billion. The PE ratio is solid at 18.38. That current dividend yield is very high at 6.5%. The current price is $35.12. And year to date, it's up 8.83%. Looking at the 5-year, historically has not been great at down negative 25.75% over the past 5 years, but it looks like it's finally on the up and up. If you're looking to diversify within the real estate sector, this is not a very exciting play, but it is one that might be a wise decision long term. The next REIT is great and it's on sale, which is what we like to see. And overall, you've probably seen that any company that has anything to do with real estate is probably down because of the Fed market rates. This is due to the mortgage rates being so high recently with the Fed combating inflation. The Fed has stated that we're moving towards better inflation numbers, and so they'll be cutting the rate down multiple times in the next year. As soon as the Fed rate drops, expect these types of stocks to gain big time. Anyway, the next REIT on this list is called Prologis Inc. PLD, and they're the largest industrial and warehouse REIT on the market. E-commerce and AI is only growing more and more, where customers are buying more from home rather than going to stores to shop. So retailers and companies need a warehouse to store their products to then ship out, and this is where Prologis is such a smart investment, as you're basically investing in the rise of technology and e-commerce long term, but in a safer way. The current price is $116.54. Year to date, like I said, this one is on sale big time, as this year alone, it's down 13.43%. Over the last 5 years, it's up 45%. The current dividend yield is 3.3%, and the market cap is huge at $108 billion. Now, this last REIT on the list is actually a bonus because it's actually a group of REITs. You know I love ETFs on this channel, and for good reason, because it lets the investor mitigate their risk while also getting a solid return. There are many good ones like REM, which has a high dividend, and then XLRE, which is the real estate select sector spider fund, which is very popular. But my favorite REIT, and the one we're going to talk about now, is called SCHH, which is the Schwab US REIT ETF. This $6.5 billion REIT ETF offers investors a straightforward, low-cost way to invest in a broad selection of domestic real estate companies. SCHH is an index fund that mirrors the Dow Jones Equity All REIT Capped Index. SCHH currently has 119 REIT holdings, the largest being the transportation logistics REIT Prologis, which I just went over and which represents just over 8% of the market value of the fund. The current price is $20.12. SCHH strives to be a tax-efficient ETF. To this end, they keep internal trading to a bare minimum. This also keeps costs down. SCHH has a low expense ratio of 0.07%. Watch this video on the best ETFs set to explode and that are all under $100, or watch this video to keep you going strong in your investing journey.